Ted Oakley, managing partner and founder of Oxbow Advisors. It is so great to welcome you on the show. Thank you so much for joining me this morning, Ted.
Thank you, Julia, for having me.
Well, I'm really excited to talk to you. Not only is it Valentine's Day, we also got the CPI report this morning, and I am planning to release this episode today. So I was hoping, Ted, we could start with the CPI, your reaction to the report that came out, and possibly some of the implications that you're thinking about there.
Well, you know, Julia, I think people probably thought we were going to really wind down on consumer prices, and didn't quite work out that way. If you look at energy and shelter, they stayed really firm. In fact, it went up a little bit. And I think that probably threw people a little bit. And we've thought this all along, that it wouldn't just come tumbling down, the inflation rate, that it would come down, yes, over time, but it would stay at, maybe 5 to 6 through the spring. And maybe this year not go below 4 or something like that, which meant, the hangover from that is that everybody wanting the Fed to turn tail and give them what they want, probably not going to happen, and at least in our opinion. But, we never know for sure, but it looks that way.
Yeah, so it looks that way. You mentioned like a lot of folks, they want the Fed to turn. A lot of folks, a lot of market participants out there that would like to see not only pause, but rate cuts and watch asset prices go back. I don't know if that would even happen, but I guess when you see a report like this and more persistent inflation, like inflation staying still at elevated levels, do you think that means the Fed will continue to hike? Like, how do you think it kind of plays into what the Fed might do?
Well, I think the thing that people probably underestimate, it seems at least to us, and we don't know anything, but it seems to us that he is serious, Jay Powell, about really getting inflation down. And he is so serious that he's not going to just, wink at it and say, okay, we're going to go back to where we were. I don't think that's going to happen this time. I think he doesn't want that to be his legacy. And so you'll notice after he got formally appointed and approved, then he went on this tough run. And I think he'll stay on it till he sees what he can get to. Unfortunately for a lot of people, we have a lot of people in the industry who have only been around for 15 years. So they've never really seen a time when rates stayed up and what to do with it. And so they're just expecting it to go back like it was the last 10 years or so. And that's probably never going to happen again, in our opinion. I'm not saying it can't happen, but we would be surprised.
That's a really good point, because you mentioned a lot of folks out there have only been in the business for 15 years. Like, gosh, I think about myself. I'm not an investor by any means, but I'm 35 and sometimes I feel like, wow, I've been doing this a long time, but I really haven't. You've been doing this for decades. Let's explore that a bit, about what folks might be missing just because of their experience, their frame of reference. What are some of those things that you think they should be thinking about?
Well, one of the things you have to do in investing, and I have to do it too, by the way, and it's a strong pull on you, is your biases. So if you're biased to what's been going on just in your career, and I'll give you a really good example for me, okay? I came in the industry, I went to New York City, and what happened was for 7 or 8 years, the Dow Jones would just go up and down 25%. It never went anywhere. The S&P the same way. And interest rates kept going up and up and up. So every time you bought a bond, 3 months later, that bond price was lower than it was when you bought it. And so you had to learn that you're going to have to keep your maturities really short to manage that. It's something happens. However, when Henry Coffin came in 82 and said, hey, it's over, the Fed's going to lower interest rates from now on, it took people like me and a lot of others, that didn't have the experience of being around lower rates, to a year or two, to say, I think that's right. And so you have to get over sort of what your experiences have been. And I think one of the things about people today, and I ran the number, gave a speech here last month, and one of the slides that our people had pulled up was that, I don't have the exact number, but something like 43% of the people in the industry today are less than 39 years old. Meaning, if you just put the math to it, that's been their experience, see, with this low Fed. So they'll have to basically re-engineer their thought process here, because you're going to have to get into a point where you realize that, hey, things probably more volatile the next 10 years. You got to look at commodities. You got to start thinking about keeping your maturity shorter. A lot of things like that enter in, and you can't just do this plug and play routine where you say, well, I'll buy 60% stock, exchange traded funds, 40% bonds. Everything will work out. I doubt if that does that way the next 10 years. That's just a guess, but I would be surprised.
That's an interesting point too. I want to just tease that out a little bit more, because this is such valuable information and insight, and it's so helpful for all of us too. And even if it's just a guess, it's still another idea out there in the marketplace for folks to certainly think about. And you kind of just mentioned like this plug and play routine that might not play out. Can we explore that a little bit further? I'd love to hear more of your thinking there.
Well, the 60-40 are really called, risk parity trade came about because, number one, it was easy. Okay. And bonds had kept going lower in yield and higher in price. And so it was fitting that you could put that in there together and that would work with the stocks doing the same thing. I think people forget that the wind has really been at their back. So actually the last 40 years in terms of the bond market, but certainly the last 14 in terms of the stock market. And so they started putting two and two together. And it was an easy way for people that didn't really know a lot about investing. Well, when I say that, I don't mean that as a disparaging remark. But what happens is a lot of people in the industry today, they don't understand single stocks, single bonds. That's all we buy at Oxbow. But, we understand balance sheet, income statements, that sort of thing. But it was easier to do just to say, okay, we'll do 60% stock, 40% bonds. And it really did work out. Okay. I mean, there's nothing wrong with it. But always in investing, there always becomes a change. And you have to notice that change. And if you don't notice it, that's where you typically get hurt. And I think people are not realizing today that more than likely, you're going to be in a different kind of period. I'm not saying you don't own bonds, but you're probably going to have to own them shorter. Why not? I can get, 4 3/4 for a 1-year treasury. So things like that change the atmosphere of it. And I believe that that's the changes that are coming. And it typically takes people that haven't been around as long, it takes them a long time to say, you know what, we got to make an adjustment, but you're further into it when they do.
Mm-hmm. This is so great. I want to just pick a few more things out because again, love the ideas that are coming up here. You mentioned like you pick single stocks and bonds, and I want to get to that too, but for folks, they might want to own bonds on, like, I guess, on a shorter term basis. Can you help me? And it might seem like a naive question. Is that because of you have to be more mindful of like duration, interest rate sensitivity? Why would you want, like, help me understand why like own them for shorter amounts of time?
Well, I think Julia, you hit the right word there when you said interest rate sensitivity. What it is that if we go into a period, and I think we very well could, where volatility in interest rates reflects to volatility in the bond price. And I think most people have been used to the last 20, 30, 40 years that they never got hurt in their bonds. Bonds couldn't lose any money for them. And so if you go into a period like last year, 22, and they look up and all of a sudden the 10-year treasury is down 18%, they're like, wow, I didn't think that would happen with bonds. And if you go forward, let's say, the rates stay high, then they go lower. And so the bonds get a move on the upside, and then they have to come back and raise them. Right. You have a Fed that's really intent on keeping things, tight. Then it'll be volatile. And when it's volatile, the only way you can survive, in my opinion, maybe people have a different opinion, I'm sure, but the only way you survive that is to keep your maturity short. And this is why. If I have 1, 2, 3, and 4-year bonds, use that as an example, that means that every year I'm repricing, no matter what the interest rate is. and the second year I reprice again. And so I keep rolling it, but see, I'm on the curve. It can't hurt me. Now it can go down and I don't get as much interest. That's a fact. But when you look back at the bond market, for example, in say 20 and 21 and 22, and you put those three together, you really didn't make much money when you look right at it. Because what happened is you had one good year, and then you had a year that's so-so, and then you had a really bad year. And so I think people have to start to realize that the only way you can guard against extreme volatility is to be able to reprice your assets all the time. And that's what we do with the short maturities.
Do you think that stock picking, do you think it's a lost art?
No, I don't. I don't think it's a lost art. You can, what you have to look at, and I think people forget about this, that all businesses, regardless of whether it's people in the real estate, people in private business, people in oil and gas, technology, stocks, bonds, whatever, it all comes back to cash flow. So if you can determine really high cash flow, particularly free cash flow after capital spending and everything, then you have a real great asset. And even though when you go out and choose that, I think that's what will be important the next 10 to 15 years. You're going to have to know what can produce that free cash flow, because the averages themselves, and I'll give you a good example, 1966 to 1983 and 2000 to 2012, the S&P made 1% compounded. So I always tell people that, because we had a lot of people that started, and they came into our offices in, say, 2015, and they just started in the market in January of 2000. And by the time they got to it took till 2013 just to break even, because it went up and down, up and down. And I think people forget about that. And that is, that's something that single stocks can offset that. I'll put it that way.
That's a good point. Well, normally I start the episode with the big picture question, and I didn't do that this time, but I do kind of want to shift and just kind of zoom out and talk about the macro, the big picture for you. If you could kind of frame up what that looks like for you today.
Well, it's certainly a tough one. I think anybody that says that they've got a really good handle on the next 5 to 10 years is a whole lot better than we are. But I think what we think about the most is this, and that is, you have these extreme high levels of debt all over the world, the U.S. included, obviously. And so that's going to preclude a lot of things that might normally go back to these normal cycles. I think that's part of it that's out there. I do think that coming off of the super bubble we were in, by the time we got to 2021, that what happened is everything was in the super bubble. And so it takes a long time to wring that out, not just 1 year, but it takes a long time to really get back to some sort of normalized investing atmosphere. So what happens in that sort of thing is, at least for us in the macro, is that we feel like if you're going to really go through this macro the right way over the next 5 to 10, 15 years, number one, you have you have a lot going on with the East in terms of China, Russia, India, Saudis. They're working on their own currency right now. That's going to have an impact for sure. And then secondly, we may or may not be as competitive in the U.S. I hope we are. But if we are able to be because of technology and productivity, I don't think it will be for any other reason. But so when we're looking at the macro right now, we feel like that we've got another period to go here of uncertainty. Now, you could say, do we think markets are priced correctly? We don't happen to think they are. And it's not because so much of the S&P, it's just because we run a lot of screens on individual companies, and they're just not cheap enough for us to want to start owning them, or owning more than we already own. We own stocks, but we're about 50% liquid. And so there'll come a point, where they get cheap enough. And I think that's farther ahead of us. I think the two things that will drive the market this year will be recession, which would be lower margins for companies and then lower earnings for companies. Last year was interest rates. This year, I think it'll be the economy. We'll see if it works out that way. And if it doesn't, we'll make an adjustment because sometimes we have to adjust.
Talk to me about, again, a lot of great stuff in here. You all are 50% liquid. Can you kind of help contextualize that? Is that higher than you usually are? Because I do know that y'all were, you had more liquidity. Well, I don't know if it was more than now, but you did get you were liquid in 2022, or I think, and correct me if I'm wrong, I believe it was heading into 2022. Can you kind of frame up, like, I guess a bit of the context there on your liquidity position?
Sure. We have three strategies, and one is a really short-term bond strategy, and then we have what we call a high-income strategy. It doesn't own bonds; it owns a lot of other things. I mean, they all pay between, say, 5 and 10% on the cash flow, but then we have just a full stock. All of those strategies we felt like would be under pressure in 22. So as we came through 21, when we would have something that came overpriced, we would turn it. And we got up to probably 20-25% liquid by the time we got to the third quarter of 21. And then as we moved into the fourth quarter and the early 22, we basically moved into, by March, we were at, over 50% in all of those categories. And not because we're trying to time the market, it just, things were too expensive. People always think, well, you're trying to time the market. We're not really. We're really trying to time the value, if you want to get right down to it. If the value is correct, we'll buy it. Even we buy right now. We had something that was really great. We do have some things that are in what we call value mode. And you look at the gold miners, that kind of thing. But in general, we're most of the companies we follow in the screens we use, they're just not at a point where we're going to add a lot of them.
Do you think that you'll see a point where they will get cheap enough? And what do you think might ultimately drive that?
I think the thing, Julia, that drives that will be the earnings. I think what people, we came into, by the time we got to mid-December of 22, the average earning estimate for the S&P for 23 was $230 or so for the S&P. We always thought it'd come in at 200 or less. Now it's down to like 221, and some are like 218. See, we think that'll keep on coming down because you think about it, at a 4,100 to say S&P 500, if you're doing, 200, 210 on the earnings, it's expensive. It's still 20, 21 times, which is not cheap under any measurement. And so for that to be measured correctly, you'd have to put yourself down, another 10 or 15% from here to get into a zone, I think, where a lot of companies would get cheaper.
Yeah. Let me ask you this. Like, what do you make of like the markets so far this year? What is your assessment there?
Well, we felt like it was, what happened this year was everything that got beat up badly last year rallied. They got beat up so badly. Now you just take a look at the FANG stock, look at all of the MEM stocks, look at all the companies that don't make any money. I mean, I went through a couple of days ago and looked at, I know, probably 20 companies that make no money, no revenue. They're public. They bounce too. And Bitcoin, Ethereum, they all bounce. All the stuff last year, they got wiped out, bounced, but ARK. And what I tell people is, look, if you go down 60% and you rally 20%, you only rallied 8 points out of that 60. So don't get too confused with it, because when you have something as bad as last year, they again, I think it's just a bounce, a lot of short covering, stuff like that, but it's a very lousy rally. We don't see it in a lot of the good companies.
You think that it also implies like there's more to come here, like more shoes to drop, or this is more just like a bear market rally? What do you think?
Julia, if I had to guess, and it's just a guess, I would guess something that would go something like this, that you'll get to a point here between now and mid-year where people will say, well, gosh, I didn't think it was going to get this bad in the economy. I'm gonna sell some now. And I think that's what's going to fool them. I think they hung on to this idea that, the Fed's going to bail us out, and as soon as times get poor, everything will be back to normal again. Normal being, 1/4 point interest rates, that sort of thing. We don't think that happens. I think they in one respect, we think they sober up about sometime in the next 6 months and realize that, you know what, we really are going to have lower earnings. So boom, I think I'll sell some stuff. Maybe not work that way, but I could see it happening that way.
So that would be would that be like the capitulation? Because we really didn't see capitulation, or some folks I've talked to, they said we haven't seen it yet.
Well, the reason we know we haven't seen it is because we have a lot of new money comes in all the time. And when you bring those accounts and you look at them and they're still fully invested in things, and we find generally, if I just ask people, even people we don't do business with, their general ideal was, well, it was a bad year, but, I had 2 good years in 20 and 21. So, I'm thinking we'll be okay. All right. See, that's what happens when you're only down 20%. But if you got down 40, then you're like, you know what? I can't take it anymore. It's sort of that. In other words, you switch into a different mode. We'll see if that happens that way, but we never got the fear. We never got, we were around too many money managers, too many people, and we never got in a situation where people said, hey, take me out. It just never came. And I do still think that they believe that, hey, the Fed, this is just a short-term phenomena and the Fed will come in and take care of us. We'll be just fine.
Anticipation of we'll see this movie play out again, or the Fed will pivot, cut, and everything will rise again.
Well, we always say to people, look, before you pivot, you have to stop raising rates. And they haven't stopped raising rates yet. And usually go through a long period, quite a long period of not lowering rates, just doing nothing. Yeah. You don't just come in and raise rates this month and then start lowering them next month, unless something really unusual happens. So, we'll see how it plays out. I think I tell people this, but let's just say the markets, kind of overall markets, not the NASDAQ, but the overall markets are up maybe 6-7% this year. Well, I'm getting 4 3/4 on a 1-year treasury. So why press it right now? Why not just give it some time and see how this thing works out over the next 3 or 4 or 5 months? And, if you get a good shot, then you've got liquidity. And if something changes and it looks like you're in a brand new, and you can tell if you're in a brand new bull market, I doubt it, but if it happens, then, you've always got bull markets won't leave you in a month. They're going to last longer than that. So people have to keep that in mind. In the event that like the Fed not only pauses, but in the event that there's a pause and then maybe at some point a cut, couldn't that be viewed as like not necessarily a good thing if they cut? Meaning, couldn't that imply that we're in some serious trouble? Well, you've done your history there, Julia, because that's what happens a lot of times. When they cut, the market actually goes lower. And because they're scared, there's something wrong, and they can see it. They can see that, hey, we've got problems here. And so that's just true. You can have it. You don't have to have it, but you can certainly have it. We've had it numerous times, really. Mm-hmm. Okay. So in your big picture macro view that you laid out, you did bring up the debt and the debt situation. Can we flesh that out a bit and how you're thinking about the debt situation here? Well, I think the biggest thing people probably don't realize is they forget what the federal government pays an interest on their bonds, that are outstanding. In other words, they borrowed a lot of money, and a lot of that's floating. If you look at the U.S. debt that they owe, a lot of it comes due in the 1 and 2 years, and certainly a whole lot of it in 1, 2, and 3. So if rates stay reasonably high, their borrowing costs are really going to go up a lot, okay? And same way for companies and same way for people. And it really changes the atmosphere. I mean, if you look at multifamily housing, and we like real estate, by the way, a lot, but if you look at real estate today, when you go out today, we have a 7 3/4% prime rate, and by end of March, we'll probably have an 8%. When you take that, and even if you get a discount to that, and you're doing multifamily out here at say 6 or 6.5, it's really hard to make the numbers work when you were doing it before at 3. And so all of a sudden everything changes for you, not just in our business, but every other business as well. If I'm doing short-term borrowing at a private company and I'm down at the bank and they're saying, hey, we're prime plus one now, so we're 8.75. That you better be making quite a bit of money if you're paying almost 9% on the cost. And that's where we are right now.
Yeah. What do you think some of the implications of that could be if we get there?
Well, you're going to see two things happen, I think, for sure, Julia. You're seeing it now. People are moving money out of the banks because they're realizing that the banks are on a free ride here. I hate to say it because I own one of the best banks there is, part of one. I'm not the largest owner, but I'm certainly I'm proud of our bank. But one of the things that happens to banks is they've had sort of a free ride in here in terms of, when the rates were all low, they could be low too, and nobody made any more money anywhere else. But all of a sudden, now the treasury rate goes way up and people are starting to notice. And so they're moving money out of all the banks. All the banks are losing liquidity. That's one. Secondly, on the loan side, it's just starting to catch up now. But what happens is those people that came in and said, I was going to buy a new piece of equipment, but I think at 8.75 or 9%, I think I'll wait a year on that, or I'll do something different. You see how it all filters in together. And maybe when the loan comes up, where normally they might renew it and go out another 3 years or 5 years, if they've got the cash, they may just pay it off because they probably can't earn 8.5 or 9% in the stock market right now. So they'll look at that and say, I think I'll just pay it off.
Yeah.
And that's the implications from that.
Okay. So you mentioned that you like real estate. There are a lot of different facets of real estate. Like maybe, okay, I'll just start with, I'll just hear your views on real estate, and then maybe we could start to zoom in on the different parts of it.
Well, one of the things I think about real estate, it is a real asset. In other words, to a reasonable degree, not always, but to a reasonable degree, it helps with inflation because you can always adjust rents and you can do things like that. And we're not as big on what we call dirt projects, which is ground up. But we certainly like projects that cash flow. If you look at, multifamily housing, you look at certain commercial buildings, not all of them, but certain ones, and even a few strip centers where they really have great tenants and you can make it work. Real estate is the only thing left today that has all the tax benefits that never get touched. They never touch it. I mean, I've watched it over the years. Every tax bill that comes through, real estate is a free ride. And so you need to think about that because that is an industry that can produce cash flow without having to pay a lot of tax on it because of everything that goes into it. And a lot of people like this. It's a real asset. You can go out and kick it, open the door, you can paint it, you can do anything you want to it. But and it's interesting about real estate with investors, and we have a lot of investors that have real estate, and we put money into real estate, but it's interesting. If a building across the street from you and you own the same rough building and it, for some reason, they sell it for 10, 15, 20% less than you think your building's worth, nobody ever steps in like they do with stock and say, well, I got to get out. They just keep right on going, see? And that's the difference between real estate. Real estate only gets bad when the borrowing costs get so high that the people that are leveraged, which a lot of them are now, get in trouble and they have to come in and sell into the marketplace. And that hurts the people that aren't leveraged because the prices come off. It's only a short-term phenomenon, a few years, but it does happen. But it's a good investment because it has everything behind you.
Yeah. Okay. How about housing? Do you focus much on housing, or do you have thoughts there?
Julia, we don't focus much on housing. I'm not saying that I have a couple of friends of mine that have thousands of houses and they've done really well with it. It's just, to me, it's a fairly high capital intensive business in terms of, having to take care of all this. It's a different kind of business. It's not something I don't think we would be interested in. And I think for the individual, a house is a home. And so you got to determine that. And if your house is your home, you shouldn't be looking at it like, well, I made a lot of money on this house. Well, are you moving? Probably not. And so I think that's where people get confused on owning their home. And by the way, for the average person in the U.S., that was a big thing for them. By the time you got to the end of 21, if you just added their home and therefore just the average person and the 401k and everything, they were at all-time highs on everything. And so they were feeling really good. Not so much now, but that's what it was then.
Yeah. I don't have a house yet, but hopefully soon. I hope there's still like a decent window to get in at some
There will
point.
be. I think people forget about the windows. I think it's okay not to have a house right now. I think you probably get better buys, in the next year or two, more than likely.
Yeah. Well, fingers crossed, because there's some neighborhoods I am absolutely in love with that I would love to get into at some point. I want to just kind of go back though, like we were just talking about like the debt situation and some of the implications there. Like, how about just like as a country, like our debt situation? And I know a lot of other countries have problems too. Like I've heard it described like that we are like the cleanest shirt in like the dirty laundry pile. But do you focus much, like, do you think about like the big picture debt situation here in the US? Do you think it will ever get resolved, or do you think at some point like it'll be like a serious problem that we're going to have to deal with?
Well, I'll tell you, the only time, Julia, that we're like today, okay, if you go back and look at the numbers, where it was right after around 1931, 32, we had total debt in the U.S. I'm talking about corporations, mortgage, everything. Everybody was roughly 380 or 90% to GDP. Okay, we're close to the same today. 375% or so, and usually the way that gets resolved, we had a really high number after the war in 1944. And what happened was, if you look at the period after mid 40s up until, say, the late 50s, what we really did is we were always inflating a little bit more than the interest rates. And we basically inflated it away. We went from a really high, debt to GDP as far as government debt, say take it from 100 points down to maybe 35. And it wasn't because of anything other than the fact, if you go back and look at the numbers, we were always inflating a little bit more than the interest rate. And that's what gets you there. And I think probably if there's any way out, I think that's what we'll do at this time too.
Okay. So like inflating a little bit more than the interest rate, does that mean like some inflation is like a good thing too? Like there is, that it's not necessarily, I don't know, maybe that's a totally off question, but I'm just thinking like you need some inflation, right?
Well, you do. Yeah, you want some. I think people fail to realize though that the only way a government gets rid of that much debt, okay, they can default on it and just say we're not going to pay it. They can do that. Makes it harder for trade after that, but they can do it. After that, they can inflate it away for sure. And they can make their currency such that, if let's say I triple the amount of currency that we have, and think about it like this, but I'm only paying from what the currency was before I tripled. So I can take a lot of that currency and pay out the debt and still be where I am. And so that could happen as well. But I don't know which way we end up going, but we'll do something probably.
Mm-hmm. And then going back, and sorry to like jump all over the place. I took a bunch of notes and I want to like make sure we cover this too. Sure. But going back, like, to just how you all are positioned, it sounds like, and correct me if I'm wrong, like it's a bit more like defensive positioning because like you said you're 50% liquidity at this point. Can you kind of like, I don't know like how much you can give away. I don't want you to have to like give away everything, but like what's interesting to you, or what are the opportunities that you're seeing right now that make sense? What can you share there?
Well, most of our liquidity, I will tell you, it's not just sitting in cash, and we're getting anywhere from 460 to 480 on that, and it's either in a floating rate U.S. Treasury, which adjusts to the 90-day rate every week, or a 1 year or a 2 year. And so we're earning money on it. It's not like we're not getting money on that, and it's there to use if we find something. two of the three strategies we have gold. We think gold will continue to do well this year. It did pretty well last year if you consider everything else. And so we have a position in regular gold, the bullion, in two portfolios. And then another portfolio, we have the gold miners, which are still really cheap today. We think you can buy the gold miners and do well with those this year. Their price to cash flow is very low on a historical basis right now. And those companies, we think, and if you look at buying of gold by say central banks, they had the biggest year in 22 they've had. Oh gosh, you got to go back 40 years or something. It's huge how much gold they bought. We think they'll continue to buy gold. I think they're, with what happened with what the president did with Russia, which was freeze those assets, that changed the game with gold, because people are looking at it and saying, well, he could freeze ours too. If I'm China, India, Saudi, so that's changed their opinion. So gold and gold miners look good to us. Energy, obviously, we own, and there's a lot of ways to be in energy and make a lot of cash flow too. People don't realize you can own the royalty companies and get great cash flows, 6, 7, 8, 9%. You can own the pipelines, gas pipelines, and get 8.5%, 9%, and that's tax deferred in that respect. And then we own, on the other side, the stock side, you can own things that don't get hurt with debt. I'm gonna give you a couple of examples. We own Visa and MasterCard. Okay, if you inflate and you have more inflatable dollars, think about it. Then when you use your cards, you're actually using them more because the amount's higher, right? And if you go look at the debt structures of those two companies, literally they could, if they wanted to just take the cash flow, they could, both those companies could probably pay off all the debt in 6 months. Their debt, their margins are huge. They're like 60% margins. People don't realize in those two companies. And so, yeah, they didn't get hurt a lot. They went up a little bit here, and they've gone up some this year. But they're the kind of companies that'll get you past the valley here, that type of thing. Healthcare, same way. You look at Humana, United Health, O'Reilly Automotive. People, when cars get expensive, they start going to the auto parts companies. And then, there's a lot of things. You look at preferred stocks, and I would recommend people really take a look at preferred stocks because they got cheap. And I'll give you an example. There's something in preferred stocks called a qualified dividend. That means that not all of them are like that, but a number of them are. And that qualified dividend means you don't pay ordinary income like you do on a lot of preferreds. You pay the capital gains rate, which if you're in a high bracket is 20% plus the 3.8. And if you think about it like that, and I'm getting 630, 640 on a preferred, even after tax, okay, I'm still getting close to 5% or 4.8, 4.85, which I cannot get in a tax-free bond right now. Like I can't get that on a 20 or 30-year tax-free bond. And so that's a really great place to be too. Those will work, I think, well over the next. And so the convertibles work well, convertible bonds, convertible preferreds. A lot of things you can do. It's just a different atmosphere than normal. But on growth stocks, they bounce and everything. But I think they're too early to say, hey, we're off into a new bull market on this stuff.
Got it. Okay. And that was again more great stuff in there. I want to go back to this gold thing because that was interesting. You mentioned like central banks buying gold, like record quantities of gold recently. That's an interesting point because it's like probably tells you something too, like what the central banks are thinking, right? About like inflation. If they're buying it, maybe that's interesting for me.
Well, I think that's part of it. And I'll go back to this. I think the other part of it is really, if you think about it like this, okay, and I'm using all these other countries, for example, and you probably, if you haven't, you've probably read up on this, but there's a thing going on called cross-border decentralized finance, and it's basically Russia, China, India, Saudi Arabia, Brazil, the BRICS, all coming together and saying, hey, we're going to create something that's a non-dollar trade entity. In other words, we'll have a currency that's not the dollar, because think about it. If I'm a country and all of a sudden I'm thinking, well, you froze the reserves of Russia. Well, I'm going to try to do something where you can't do that to me. All right. Well, you can't freeze gold because I own it, number one. And number two, if we have a currency that's not wrapped around that, I could see the countries using gold as a backup to them. And that's not to say some of these others may not go up too. I mean, you may get a move in some of the, Bitcoin or Ethereum. I don't know. We don't own that stuff, so I can't tell you that. But I do think there's been a change, and that there's a lot of gold buying and not a lot of gold production. That's one of the things. And a lot of people will tell you, hey, gold's a thing of the past, blah, blah, blah. And I know I hear it all the time. But if you go back to 2000 till now, gold's been the number one performing asset. That's all I can say.
Yeah. Wait, real quick though, like, because I think probably you're not in crypto. You don't have a position there, but do you have like thoughts on crypto or Bitcoin? Some folks have kind of likened Bitcoin specifically to like a digital gold.
I understand what they're saying. I really do. I understand what the thought process is there, is that we want something that's not controlled and can't be looked at all the time by governments, and we have a controlled, if they want to, I don't call it a currency because it's too volatile, but I do understand the thought process there. I think, unfortunately, if you look at the 8,800 either coins or coin exchanges, et cetera, that are out there, there's probably only 10 of them that are viable. And if anything's going to be viable. So a lot of people, I think, will lose a lot of money. It's been an unregulated industry that unfortunately has been they just didn't do anything with it. It was non-regulated. You could do a Wild West type stuff as far as raising money and bringing people in and front running and insider trading. All of that stuff for that is out there. And I think one of the problems with it will be if you get into the differences between, I understand difference in Bitcoin and Ethereum, proof of work, that proof of stake, that sort of thing. I understand that, but I think the average person is going to have a real hard time understanding it, and it'll be hard for them to do. But I would imagine probably, Julia, that some of the coins, some of those will get to the other side. Yeah, I think they will, but just not something we do, because if something doesn't, like for gold, for example, it doesn't cash flow. Now the miners cash flow. So that's why we have some gold, but not a ton, because it doesn't cash flow. And then we have miners on top of that. But, you don't get any cash flow particularly out of the coins.
Yeah, that makes sense. Like the cash flow part. Also, just like when we talk about like cryptocurrencies, for example, it's that to me, like when you mentioned early in the conversation about like how we're coming off this super bubble. Well, I would think like cryptocurrencies, for example, very emblematic of that. Can you kind of explain to me the super bubble thought there, like the thoughts on the super bubble coming off of that, and what a more normalized investing environment looks like in your view?
Well, I think you can see it today in the marketplace with everybody that's back into the meme stocks. And, there's the options market now where half the market is one day, options that expire. Then what's happening is the what I would call the very, very speculative fever is still there. We thought it would go away after last year because a lot of people got beat up in a lot of areas, but it really didn't. It's still there. So I think you have to keep on wringing it out to where people finally get to the point to where they say, that was another time. And see, I've been around before to see Cabbage Patch dolls at $3,000 a piece and Beanie Babies at $50,000 and that sort of thing. And I often wonder where those are today, if they're up on a shelf somewhere or something happened, because you see these fads, they come along. Okay, they do. Okay. And they last a while, and the early people do well in them. But they go away eventually because there's nothing underneath them. And I think that still has to go. I don't think we're at a point where you're back to normal investing. Should be something on the order. If I put in money today, okay, what kind of cash flow can I expect? Where do I think this company or this business or this piece of real estate will be 5 years from now? What is that? Okay. And that's where I think we have to get back to.
Yeah. Ted, it's been so great having you on the show. And, one of the reasons I reached out to you, I listened to a podcast that you did with Liz Clayman, and I was really touched by like your own personal story. And I think also it kind of probably ties into like your philosophy on investing, and also just some of the incredible work that you do within your own community. And if you don't mind, would you be willing to share like your background with the folks who are watching and listening?
Well, yeah, I don't mind at all. I don't think I'm, honestly, Julia, I don't think I'm that rare. I know a lot of successful people that had really tough backgrounds. I mean, and I've always learned from them, and I try to find out how they did it and what went on with them. And some of them had much worse than I did. But I grew up very poor. I had we were hillbillies really, and back in the very, very southern North Carolina, northern Georgia. And it was back then, we didn't have running water. We had an outhouse. We only had a sort of a 2-bedroom shack, but, it was a different life. I think people and everybody learns from their life, some form or another, but I was a poor life and really an uneducated atmosphere. From a family standpoint. I think the only book or 2 books we had in my house were the Bible and maybe another version of the Bible. And so I had to educate myself, which I think everybody needs to do. All right. I think that's what gets you out. And so I use that in my own life in terms of helping foster kids. I've started really the 2 largest foster child foundations in Texas. And we help between the 2 of them, probably 8,000 to 10,000 kids a year, depending on the year. But the key for me there is if I could educate a lot of those kids, maybe they win. Maybe we can get them out of that, because you could get them educated and then they go on to do well in the world. And I've always said I really personally would never want my name on a building or anything, but I would love to have my name on the back of all of the kids I'd help 100 years from now, sort of a legacy of life kind of thing, because I love to see them do well and go on. You can't help them all. There's no question about that. And every state has a lot. It doesn't matter which state you're in. But that's how I really tried to push it back. And everybody does it a different way, but gosh, I've talked to so many business owners over the years that were successful that they had it tough. They came from some of them a harder life than I ever had, for sure. So I know it's out there, and I always try to tell people like you can get ahead. You just need to stay with it, and get educated.
Yeah. And I think it's important to tell those stories too. And I've interviewed many folks over the years who've had, tough upbringings too, and have gone on to achieve incredible levels of success, but more importantly, really investing in their communities. And like the work you do with foster children is really incredible. And, maybe as we wrap this up, I'd love to give you a few minutes to share, some parting thoughts, maybe some things that we didn't bring up in the conversation that are top of mind for you. Also let folks know where they can find you, your firm, learn more about your firm. And also if you want to share more about the work that folks might be able to contribute with the work that you do with foster children, please take a moment to do that as well.
Sure, I'd be happy to. First of all, on the foster kids, both of our foundations are called Foster Angels. There's a Foster Angels of Central Texas. It's almost 30 counties. And the Foster Angels of South Texas, which is probably 31 or 32 counties, and help a lot of kids in those. And, one of the things I like about our foundation, we set it up that way, by the way. It's 501c3 too. It's not a private foundation. But one of the things I've always had a trouble with in some things that raise money is, 50, 75% of it goes upstairs. and it doesn't really get to what you want it to. Well, all of ours goes to the kids, and which is what we really want to do. But that's where that is. Our company is, we have a great website. It's just oxbowadvisors.com. And we have all sorts of things in there. We've written, I think I have 9 books in there, and you can get a copy. We'll give it to you. And it talks about everything we do, really, the systems we have, what our processes are, what our strategies are, that sort of thing. And we're not for everybody. I know that. But if you have a fairly conservative bent, you're preservation of capital oriented, then you would have an interest in what we do, because we're not going to be quants or hedge funds or any of that kind of thing. We're real basic, but people like it over the years because we've done it a long time. They like it. They like common sense. And then last thing I'd say, I look at a lot of young people that are either in the business or starting to look at the business and that kind of thing. And I always try to give them a little piece of advice, which is, be careful of your own bias. One of the things, the hardest thing to overcome in investing is your own bias. I don't care if you're an individual or us as professionals. You have a tendency to be biased to something, whatever it is. And personal story, by the way, my bias was to hold on to every penny I ever had, because I never had any. But by the time I was 40, I got rid of that. And it took some time and some talking to a lot of people, but I was able to do that, okay? Because your biases will take you in different directions. Some people's bias is to spend everything. I don't care how much money they have. And then some people want to save it all for the kids. I mean, there's all kinds of bias. I'm getting ready to have a new book come out entitled A Balanced Portfolio, which is basically your ticket to a peace of mind. And I think people forget that today. The idea about investing is to have your money be able to buy 10 years from now the same thing it would buy today. That's the deal. Nothing more than that. All right. You're going to make, everything's going to go on. But if you can buy the same thing 10 years from now that you can today with your money then you won the battle, and it's really what it is when it gets right down to it. So anytime they have a question, there's a lot of things on there. They can see that on the website. But Julia, they can get everything. They get everything there, I think.
Ted Oakley, founder and managing partner of Oxbow Advisors. I thank you so much for being so generous with your time, your ideas, as well as your wisdom, and just an overall incredible conversation. Really, really enjoyed having you on the show. Ted Oakley, thank you so much.
Thank you, Julia. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.